global steel production is edging lower, partly due to weakening demand from the iron ore hungry China. Despite the fall in output, the major iron ore producers are increasing production, which will weigh on the commodity price and the federal budget. The big companies like BHP, Rio and Fortescue are starting to diversify their production ahead of this structural shift in the commodity markets. For more on this, I'm joined by Richard Creed, credit analyst at S&P Global. Richard, thanks for your time. Just want to start with that diversification strategy that the big iron ore miners are on. What are they doing to diversify their businesses?
Oh, thanks, Ed. What we're seeing is that after many years of iron ore powering their earnings, they're looking to diversify as steel production in China has basically plateaued. So when they're looking for growth, they're now, in the case of the integrated miners, they're pivoting towards commodities that will benefit from the energy transition, such as copper. In the case of Fortescue, they're pursuing a decarbonisation strategy to make their output more attractive to the Chinese steel mills who are also seeking to decarbonise.
Yeah, I've looked at your report and it does show steel output falling from China, but picking up from some other places like India. But is there going to be emerging economies like India that will be able to pick up the slack, or is the sort of the iron ore boom now really coming to a big end?
Well, it's really plateauing, we think. So China accounts for more than half global steel production. So even though emerging economies like India are increasing their production, it's really a fraction of what China does. So China produces over 1 billion tonnes of steel, and India is looking to grow to sort of 140 to 150 million tonnes. So it's just over really 10 to 15% of China produces. So what China does will drive steel production and will drive the iron ore demand.
And what are the big changes that have been happening in the China economy over the past couple of years that are causing this plateau in demand for steel?
Sure. Well, if you go back to 2022, you can see that housing demand was for about 300 million tonnes of steel consumption. Now our S&P Global Market Intelligence business is projecting that next year that demand will fall to about 200 million tonnes. So that's quite a fall, and that's really driven in the softness of the housing sector in China, which we expect will continue given the demographic trends that are in that sort of country. So all in all, we think that the Chinese steel production is likely to begin to edge down over the rest of the decade. It will still be quite material, and so the demand for iron ore will be material, and so iron ore will be a very important part of these businesses going forward. But it's really about looking for growth and diversification for these businesses to keep them to keep their earnings stable as they fund that diversification strategy.
Yeah, I remember at profit reporting season in August, a couple of the iron ore miners here on the ASX talked about this new big hydroelectric dam project that China were going to start building in Tibet, and they were suggesting that would be a really big driver for steel production over the next decade or so.
Yeah, we think so too. That could well be a demand pull-through piece, but you have to remember that that's just one part of demand for steel in a very large economy. So even so, wider trends like what's happening in the housing market and just more broadly infrastructure spending and the ability of China to continue to push steel into its finished products, particularly autos and the like, and it's currently exporting 100 million tonnes a year. So all those trends and what happens in those segments of the market will be at least as important as big new infrastructure projects as well.
All right, so where do you see iron ore prices going long term?
That's the tricky question. So we don't generally, for our credit ratings, try and project the prices exactly. What we do is we try and triangulate around what looks like a reasonable assumption for our credit ratings when we determine our credit metrics. And at the moment, we see about $90 for next year being an appropriate assumption, reflecting that softening of the Chinese economy and the demand for steel in the housing sector. So, and that compares at the moment to the current price of about just over $100, and over the last 12 months it's really ranged between $95 and $105. So not a huge change at the moment, it's just really edging down for the near term. In the longer term, some of those structural trends about increasing supply from the majors, what happens to Chinese demand, and also the decarb strategy in China will also play a part in the demand for iron ore and the sort of ore type that they're looking for.
Yeah, and obviously we've just seen the Simandou project in Guinea has had a big opening ceremony just recently. That's exactly a huge additional part of supply going to the iron ore market at a time where the other iron ore miners are boosting production as well. I saw in your report Vale in Brazil are looking to really ramp it up as well. So could prices potentially go down even more in the future with a bit of a supply glut potentially happening?
Yeah, that's absolutely a risk. So we see Simandou at full production being about 120 million tonnes by the end of the decade. So that really could cause a structural change in the market at the margin and cause prices to edge down. And if indeed that was to happen, then those iron ore producers that are higher cost, that are smaller, they may well face the full brunt of those structural changes. It's important to recognise, though, that the major iron ore producers are pretty low cost. So even if prices materially move down, they will still be profitable. It's just that they won't make as much money. But there could well be a structural change in the industry that the smaller producers are more exposed to, and those that have got a lot of leverage and a lot of debt, they are probably the most exposed. So we would expect lenders to be having a careful look at their portfolios and who they've got exposure to over the coming years.
Richard Creed, credit analyst at S&P Global. Great to have you on the show.
Many thanks for having me.